Hey, what's up, guys? Welcome back to my world of stocks. Now, the stock market, as you guys know, has been a bit shaky in recent weeks. And personally, I still think it's a bit too high, but I gotta admit, there are quite a few stocks out there that are looking very attractive. So, a lot of stocks in correction right now, meaning they're down well over 10% from their highs. And that got me thinking, what are some good stocks to be purchasing right now on any dips? I've got four stocks in particular for you guys today. All of these stocks are down from anywhere from like 15 to 30% from their highs. So these are some pretty big dips. And I think these are great long-term stocks. So I went ahead and picked out four stocks that I really want to buy already at these prices. And there's one that is going to be a value dividend play. Another one's going to be a growth stock. Third one will be a foreign stock. And then we've got a core foundational stock. So we've got a bit of variety in there as well. So should be a lot of fun. I hope you guys enjoy this video. Let me know what you think down below. Hit the like button if you enjoy the video. It really helps the channel. Let's go ahead and jump straight into this. Okay, now kicking things off here, let's start with our value dividend stock. And for this one, I chose the pharmaceutical giant Merck, ticker symbol MRK. And this is a stock that up until 2020 was performing pretty well, but has since dropped by around 18% from that high. Now, there's a lot of reasons for that, like fears of drug price reform, as well as a down year in profits last year for them. But this is still a very solid company. Profits are usually in the billions, while sales are in the tens of billions, with this year in particular expected to be a rebound of almost 10% growth in revenues, while both this year and the next are also expected to see double-digit growth for their profits as well. Meanwhile, they have what many predict will be the best-selling drug in the next couple of years in Keytruda, which is estimated to generate a massive over $22 billion all on its own by 2025, which is about half of all the sales that Merck brought in as an entire company last year. And it doesn't even lose patent protection until I think around 2028. So plenty of years to keep raking in huge amounts of money, and even when it does lose that protection, Merck is already working on a robust pipeline to offset the declines in the future, which includes various treatments for things like cancers, various illnesses, and even the pepperoni. And yet because the stock is trading so low, their forward P ratio is actually close to 60% cheaper than the rest of the sector, leaving them with a very nice dividend of over 3.5% on a low payout ratio of only around 40% and 11 years of consecutive growth. Add it all up and Merck is looking really good to me right now. So I actually went ahead and just started picking them up, started buying into this stock today actually. I am actually very happy to add this one to my dividend portion of my portfolio. By the way, Warren Buffett recently purchased this one as well, and I gotta say I agree with his decision there. Okay, now next up here, let's jump into our growth pick, and for this one, I gotta go with one of my absolute favorite long-term tech plays in Nvidia, ticker symbol NVDA. Now, when looking at this stock, they saw a huge surge in 2020, but are now starting to correct a little, with the stock recently dropping about 25% from their high. And I'll just tell you guys right now, I went ahead and bought some more shares earlier today as well, because I'm really liking this dip on Nvidia. Now, don't be fooled though into thinking that this is all of a sudden a cheap stock. Nvidia is still very expensive at a forward P ratio of 36, but there are plenty of reasons to think that they will eventually grow into that valuation over time. For one, I actually think Nvidia's biggest growth will come years from now in the future, and yet we are already really seeing them start to put up impressive numbers. This year, both their sales and their profits are expected to climb by over 30%, and that's despite them having already climbed by over 50% the year before that as well. But the reason why I think that the larger growth is actually still to come is because Nvidia operates in very large markets that I think will be the foundation of almost everything that goes on in the future. And Nvidia, I think, will be powering most of them with their high performance processing chips, as well as their various platforms and softwares. For example, in the data center market, Nvidia estimates that their total addressable market will surpass $100 billion in just a few years from now. For context, their data center revenue was less than $7 billion last year, and that was even after 124% growth year over year. So just imagine all the potential for even more growth that is still on the table, especially when you consider their new class of processors processors called DPUs that are insanely more efficient than CPUs, and a couple of blockbuster acquisitions in Mellanox and ARM that will help their products and services expand to literally trillions of devices worldwide. Not to mention other areas for growth as well, like for example, gaming, where literally billions of gamers worldwide will keep demanding that the market produce the most kind of lifelike gaming experiences possible. And I think Nvidia will continue to play perhaps the biggest role in that as they lead the way in virtually all new graphical gaming technologies like ray tracing, artificial intelligence, and advanced shading. Now, there's also the electric vehicle market that will soon be overtaking traditional gas vehicles as more legacy automakers try to desperately fend off Tesla. But if there's one thing that we can all agree on here, it's that the legacy players will need robust autonomous driving platforms if they ever dream to compete with the likes of Tesla. And one of the easiest and kind of fastest ways to do that, I've said this many times before, is to hire a third-party company like Nvidia to actually do it for them, who already has close to 400 different partners. And finally, I think that the most overlooked and kind of future growth driver for Nvidia will actually be the Internet of Things and smart cities, all of which can be powered in some way by Nvidia. As our populations keep growing and many large cities struggle to fit all of the people in there, the fact of the matter is that we're gonna have to learn how to run cities more intelligently and more efficiently, and that's exactly what Nvidia's Metropolis platform has already been working on for years. They use artificial intelligence and deep learning to improve public safety, traffic management, and resource optimization. I think that market is going to blow up huge over the next couple decades and well into the future, and it's going to require a lot of platforms and sensors and hardware and software and a ton of data to really be processed very quickly and efficiently. And I think Nvidia has one of the best shots of leading the way in that market. So I'll gladly buy Nvidia now at higher prices for the exciting future that I think they're going to have. Okay, now moving on to stock number 3, that's going to be our foreign stock. And really this one could easily count as another growth stock as well, like similar to Nvidia, but that's going to be the Chinese e-commerce giant in Alibaba, ticker symbol BABA. I know, not a huge surprise, I've talked about them a lot in the past, but this is also a stock that I do already own myself, and I would love to buy some more on this dip here. Speaking of which, up until recently, the stock was performing extremely well before finally taking a dip over the past couple months, as they are now down about 30% from their highs at the time of this recording. And there's several reasons for this. For one, Chinese regulators halted the IPO of Alibaba's largest spin-off company called Ant Group, who is famous for their Alipay service that holds over 1.3 billion users worldwide, which for context is about 3 to 4 times larger than PayPal. And after delaying that IPO and forcing them to make changes to their business, China went on to launch an antitrust probe against Alibaba, which spooked investors. In case you guys don't know what that means, it's basically when a company gets too large, sometimes the government will investigate them and try to kind of put stricter regulations on them so that they can't really act like a big monopoly and do shady things that will make it impossible for smaller companies to compete with them. Anyway, there was also a US ban on certain Chinese stocks, although it was later revealed that Alibaba would not be included on that list, at least for now. But because Alibaba is one of the most heavily invested in Chinese companies in the United States, investors got scared that a huge portion of its investor base would be forced to sell, and that, coupled with all of those other issues, just really added up to a big drop in the stock price at a time when most other tech companies, especially e-commerce ones, have really been soaring because of the pepperoni lockdowns where everyone's been using like all of their services. Now, those that are bullish on Alibaba, though, myself included, feel that now that a lot of this like negativity is being priced into the stock, this could turn out to be one heck of a buying opportunity for the long term. Now, just to be clear, I don't ever buy too much of an amount of like foreign stocks, especially Chinese ones, because of all the risks that they carry, which I've discussed in previous videos. But if you're able to look past that and accept the risk, there's actually a lot to like about Alibaba stock. For one, the stock is trading with a forward PE ratio of less than 20 and a PEG ratio of less than 1. Yet when you look at their financials, the company performs similarly to Amazon with unbelievable growth for their already gigantic size. This year, they're expected to do over $100 billion in revenue, and that's still with growth of over 40%. I mean, what other company out there has the valuation of Alibaba and still puts up these kind of numbers? And it's not like they're not profitable or like there's something seriously wrong with their business. In fact, they're very profitable with over $25 billion in free cash flow over just the past 12 months. And all of this is in US dollars, by the way, not like Chinese yuan. Now, if you want to know how Alibaba is doing this, all you really have to do is read this new report from eMarketer that just came out recently, where they estimate that China will become the first country in the world to have their e-commerce market make up over 50% of all their retail sales. No other country in the world even comes close. South Korea in second place doesn't even reach 30%. Then you look at the United States, they're only at a measly 15% by comparison. To give you some more context, China's e-commerce market is expected to grow by 21% this year as it approaches $3 trillion in sales, which is like more than 3 times larger than even the United States. That's pretty crazy. And of course, Alibaba dominates most of this market at over 50% market share. The next closest is JD.com, and it's only at about 15%. By the way, eMarketer also specifically mentions the global health issue and the resulting lockdowns as something that has really pushed online sales even further. And they note that online grocery shopping has really surged recently, and that may be a change that is here to stay. Well, guess who just increased their stake by literally billions of dollars in one of China's largest hypermarket and supermarket companies that operates close to 500 individual stores? Yup, Alibaba did. And that's going to dramatically increase their footprint across the country, making it even easier to implement online grocery shopping, among other things. Then you add on their largest market share in cloud computing in the Asia region and all kinds of other projects in artificial intelligence, gaming, and even electric vehicles. And you're talking about a massive company that isn't going anywhere. The risk to investors is that because it's a Chinese company, we can basically get screwed at any moment as investors, or I should say as like foreign investors. But for me, the stock is just too attractive to ignore, and especially the further it drops. I really like it here, even with the added risk. Again, I know Chinese stocks are controversial. I'm not saying, there's even ethical issues and all kinds of stuff. But in terms of just looking at it objectively as a stock, I gotta say it's really an attractive one. Okay, now finally we are down to our core foundational stock, a stock that one could theoretically build like an entire portfolio around because of its massive size, profitability, solid business, and overall reliability. And right now, I gotta say the social media giant Facebook, ticker symbol FB, is looking pretty damn attractive. Now, they've always been a pretty decent performer, and they especially had a very strong 2020, leaving them up over 140% in the past 5 years. But they've also been known to go through a few dips once in a while, and the last few weeks have been no exception, as they're currently down about 15% from their high. That's good news though to any Facebook bulls out there, because it leaves one of the biggest companies in the world with actually a very attractive valuation at a PEG ratio of less than 1. For context, that's cheaper than any of the giant FANG stocks, including Microsoft. So like Amazon, Apple, Netflix, Google, Microsoft, Facebook beats all of them on value based on that PEG ratio. And yet it's not like Facebook is a dying company or, kind of struggling to grow or anything like that. In fact, they could easily be considered the third growth stock on today's list, despite their already massive size. Sales are expected to surpass $100 billion this year, and yet they continue to put up growth rates of over 20%. That is insane. Of course, a ton of that growth is sadly thanks to the pepperoni lockdowns, as people are kind of stuck at home and spending so much time on their phones and on social media. But for Facebook, it's now given them over 3 billion monthly active users on at least one of their several apps like Facebook, Instagram, Messenger, or WhatsApp. That's getting pretty close to half of the entire world's population, which companies can directly advertise to by paying Facebook a fee. And as long as Facebook's apps stay relevant, the money will keep pouring in, because these advertisers love the fact that they can target directly to any audience they want, since Facebook basically knows everything about you at this point. Whether that's ethically good or bad, it's just the reality that we live in right now. Now, admittedly, I've always been hesitant to buy Facebook myself because I feel like people are getting pretty bored of Facebook itself, like Facebook.com. I actually never even use it myself, but Instagram, on the other hand, has been on fire for years and continues to grow larger. Check out this chart here from Pew Research showing social media platforms. You can see that Facebook kind of flattened out there in recent years, but Instagram completely took off and left all the other competition behind in terms of growth. Although admittedly, TikTok has probably been seeing like much higher growth, but they're not included on this list because I think it went a little far back. Either way though, I really don't think Instagram is going anywhere everywhere because they have a huge young user base. In fact, 72% of all teens say they use Instagram, and 73% of them say that it's the best way for brands to reach them about new products. That's pretty crazy. Because of that, it's estimated that over 75% of all US businesses are already on Instagram. And according to Smartly, around 65% of all social media ad dollars are spent on either Facebook or Instagram. So as long as Facebook can stay relevant as a company and either keep their apps popular or introduce new ones, they'll likely continue to dominate. That's a very real possibility, especially in terms of making new ones, considering that they have so much cash to spend on virtually anything they want. Operating cash flow was nearly $40 billion last year alone. And they have one of the best, absolute best balance sheets in the world right now at over $75 billion in current assets. That's more than double all of their liabilities combined, and they have a current and total ratio of both above 5. That's very, very high. In case you're not familiar with those ratios, you want to be above 1, but being above 5, that's crazy. Add it all up, and really I think the only threat to Facebook's dominance will be like antitrust regulations from the government if they try to like break them up or put other restrictions on them. But even then, at today's valuation, it's still pretty attractive, even if some of that stuff ends up happening, even if they were getting like split up or different things. Anyway, those are the stocks that I'd like to keep at the very top of my watch list right now. Stocks that I want to purchase. Nvidia and Merck I actually already started purchasing today, and then Alibaba and Facebook still kind of considering it. Alibaba is a stock that I do already own. It is a big position, so maybe just kind of nibbling a little bit. And then Facebook is that last stock that I don't own yet, but definitely thinking about picking it up right now. So anyway, that's kind of what's going through my head right now. I hope you guys enjoyed the video. Let me know if you agree or disagree with anything I said. Any stocks that are on your radar, make sure you let me know down below. I'm always looking for more stocks to throw into new videos. But thanks again for watching, guys. I really appreciate all the support. I'll catch you in the next one. Hope you're all doing well. Take care. Bye-bye.